Joining me now is David Garofalo, CEO, President, and Chairman of Gold Royalty. Great to see you, David.
Great to see you, Mark.
You're a well-known name in the mining sector, and gold specifically. We know that, but I'm curious, what prompted this pivot in 2020 or so to get into the royalty space? What prompted that change? What was the genesis?
Well, what I see in the producer space is a couple of dynamics. One is that they're cannibalizing themselves. There hasn't been any growth in reserves for well over a decade. In fact, gold reserves peaked in 2012, and the industry's been shrinking ever since. And it's become an existential imperative for them to merge with each other just to stave off an inevitable decline in reserves and production at the company level. And so that theme is going to occur for the foreseeable future. And there's been a significant underinvestment in exploration and development over a number of years. And so I think the industry, at some point, when they're finished eating each other up like Pac-Man, they're going to have to reorient capital back in exploration and development. And they're going to require royalty players in order to provide that capital, particularly in an inflationary environment like we're experiencing right now, because their margins are going to be under pressure. They're not immune from inflation in the general economy that we're experiencing right now. And we've seen that it's overhung valuations in the mining space as a result of that. So I didn't want to be in that type of dynamic anymore. I firmly believe in the bull scenario for gold, but I want to be insulated from inflation. And that's what a royalty model provides, is that top line exposure with insulation from cost pressures that unfortunately the producers are going to have to face for the foreseeable future.
We saw more of that Pac-Man in action just today, actually, that the Newmont-Newcrest deal was announced, as you know. All right, so Gold Royalty, you own 200 plus royalties. You've got 7 producing. Mm-hmm. You've got 3 foundational assets. Many of those were through acquisition. So can you give us a brief overview of what you have there?
Well, it's a startup, really. I mean, we conceived of Gold Royalty about 3 years ago in a private enterprise. We started with 18 royalties, a relatively small portfolio of development stage royalties. But on the strength of that, we IPO'd and raised $90 million US on the NYSE American. We got a strong currency and we used it. We bought Ely Gold, we bought Golden Valley and Abitibi royalties, 3 of our peer companies, and very quickly increased our royalty portfolio, diversified it from 18 to over 200 royalties. And you correctly pointed out we have 7 producing now. We have another 14 in various stages of construction. And as a result, we have 60% compounded annual growth in our revenue right through the end of the decade, underpinned by a royalty on Canadian Malartic, Canada's biggest gold mine, Côté, which comes into production next year and will be Canada's 2nd biggest producing gold mine. And we have a royalty on the underground extension of Goldstrike, which is the US's biggest producing gold mine. So we have an enviable foundational asset base, but a very diversified portfolio beyond that of early stage exploration right through to development.
Right, so by the end of the decade, you'd like to have, let's say, 20 plus producing assets, essentially. You want to go from about $6 million in revenue annually this year to about 60. So can you flesh that out in terms of the timeline and also how that compares to the growth of your peers?
Yeah, so next year we're going to see a step change in our revenue as a result of Côté coming into production in the first quarter of next year. That's IAMGOLD's flagship new operation in Ontario. Then we're starting to see a ramp up gradually in the Odyssey underground extension Canadian Malartic, over which we have 3% royalty coverage on a significant proportion of the resource. That'll represent a number of step changes in production over the course of the next several years as they start to ramp up the underground and demobilize from the open pit to exclusively underground production. And then Ren is quickly being incorporated into the mine plan by Barrick and Newmont at Goldstrike, because the grade there is about 7 times what they're mining from the open pit on what's now a 2 million ounce resource, and they're foreseeing 150 to 200,000 ounces of production by the middle of this decade. So those 3 are really the biggest drivers of our revenue growth. But as I said, we have a very broad array of smaller royalties within the Americas, in Quebec, Ontario, Nevada in particular, that are driving that revenue growth as well.
I'm just curious about the big players like a Barrick, like a Newmont. Why do they need royalty deals? Is it just to spread the risk, essentially?
So those royalties were actually originated through our royalty generator model. And what we do is we stake exploration claims around the producers.
Oh, okay.
And then we wait for them to knock on the door, because deposits don't understand man-made boundaries. And so as they have to drill under our properties, we farm them out and take a royalty back in return. And that's effectively how we came up with the Ren royalty, which is the underground extension of Goldstrike. That's how we came up with the Canadian Malartic royalty. Our predecessor company, Golden Valley and Abitibi, run at the time by Glenn Mullen, who's on our board, staked exploration claims around a prolific geological district and waited for the explorers, the developers, and operators who needed those properties to knock on our door, and farm them out to them.
Right. I've heard you talk about that. You actually have prospectors out there prospecting and staking claims and doing that kind of thing. And so it works out, doesn't it?
Yeah, and specifically, it's two gentlemen who have 30 plus years of experience in their own right. It's Glenn Mullen in Quebec. It's Jerry Boffman in Nevada. We have small office in each of those areas in Reno and Val-d'Or. And again, all they do is look at the geological map and just stake exploration claims every day. They generate 3 to 4 royalties per quarter for us. Admittedly, longer dated royalties, but they cost us nothing other than their sweat equity. And you can imagine if they hit, the rates of return are infinite.
That's fascinating. Now, you've said that some royalty companies are most of the people working there are kind of more like financial engineers, whereas your team is experienced, diverse, a lot of mining experience. And I know you're not disparaging rivals, but is that your main differentiator, do you think?
I think it's one of the reasons we've been able to grow so quickly. We have 400 years of industry experience in our board of management. A lot of people around the boardroom table that look like me in terms of the experience level, and many of them are operators and mine developers. And so I think that's a unique value proposition of a company, at least in the smaller cap universe of the royalty space. And it gives us 2 distinct advantages. One is a clear-eyed view of the underlying risk of what we're investing in and how to price that appropriately so we get an adequate rate of return, because we've been developers and operators in our own right. And the other thing is it gives us access. There isn't anybody in the industry we can't pick up the phone and talk to, whether it's me or one of my board members or one of my key senior management. The head of corporate development, for example, at Gold Royalty, John Griffith, was the head of Merrill Lynch's mining group. Bulge bracket U.S. firm. There isn't anybody in the industry that doesn't know John. So that's given us the ability to transact on deals on a bilateral basis. We've tried to compete in competitive processes for royalties, and in virtually every case we failed because we can't pony up to pay what Franco-Nevada pays or Wheaton Precious Metal pays. But if we can get into a bilateral situation before our peers are even aware that the opportunity exists, that's a competitive advantage. And that comes from the fact that we have that kind of access within our board of management.
Now, David, in terms of gold itself, you made the comparisons to the way gold is, or the environment for gold right now, to the late 70s, early 80s. We know that, so with the key difference being the global debt burden. I think you said that debt to GDP now is like 300%, back then it was about 100%. So if Jay Powell really wants to emulate Paul Volcker to slay inflation, is it virtually impossible for him to do that because it's just too expensive because of the debt burden in the U.S.?
Precisely, and I guess a microcosm of that, or a macrocosm of that, is the U.S. debt burden at the government level. In just the last 18 months, with the tightening we've seen, unprecedented tightening of nominal rates, we've seen U.S. debt service more than double to $1 trillion a year. That's 1 out of every $7 of tax revenue generated in the U.S. If they brought interest rates up another couple hundred basis points in the next year, that would double it again. It's unsustainable. And that's really a microcosm of what's happening globally in terms of debt burdens, not just at the government level, but at the corporate level, personal level. It would bankrupt a lot of governments, individuals, corporations. We're in a very, very difficult quandary for the central banks. And so if Jerome Powell was serious about slaying inflation, we'd see nominal rates well above headline inflation. We haven't seen that. That's what Paul Volcker did in the 70s and 80s. He brought interest rates, if you remember, to 20% against headline inflation numbers of 14%. So he was serious about taming inflation, and he had the latitude, as you correctly pointed out, to do that because debt burdens were so much lower. They were sustainable. You could find a fiscally responsible way to repay the debt back then. The only way to deal with debt today is to inflate it away.
Now, continuing with that theme, there are so many tailwinds for gold right now. We don't need to detail them necessarily. Most people who follow would know them. But would you say that the first question would be, is this probably the best setup you've ever seen for gold in your career? And it is really the main reason, again, to your point, real rates and the relationship with real rates.
Yeah, and the negative correlation between real rates and the gold price over a 50-year period since the U.S. abandoned the gold standard is striking. Very high R squared for the statisticians up there. And so we are not seeing increasing real rates. We're seeing declining real rates because, look, the headline inflation numbers vastly understate the reality on the ground. If you're putting food in your stomach, fuel in your car, a roof over your head, it's not 4, 5, 6, 7% inflation. We're deep into double-digit territory. Those baskets are disingenuous at best, the CPI baskets. So we're not anywhere close to neutral in terms of monetary policy. We're still very much in stimulative territory. And that underpins, I think, a huge run of the gold price, unlike anything we've ever seen. If gold achieved its real all-time high, it'd be $3,000 an ounce, not $2,000. If you look at where gold was in the early 1980s and inflation adjusted. So we're a long way from there.
Now, I was saying off air before we started, I saw a really interesting chart from Hedgeye Risk Management, which showed, and it went back decades, and it showed in the second half of bear markets, M&A would usually pick up in a big way in the gold market. We talked already today about the Newmont-Newcrest deal. Do you agree with that? Is that sort of historically what happens? There is M&A, and that kind of lifts all boats in the gold sector. And why is that dynamic at play, do you think?
Yeah, it's not terribly intuitive. You would think that the gold price would lead M&A rather than the other way around. But history has shown that when M&A picks up, it seems to almost anticipate a rally in the underlying commodity. And that's true across the commodity space, not just uniquely to gold. And we've seen really since 2018 a real big pickup in the M&A cycle because of the dynamic I was talking about earlier on, the need to cannibalize because of the lack of exploration success and lack of investment in new development projects. They're going to have to buy it if they're not finding it in the ground. And so I think that's going to run its course. I think we're going to continue to have M&A because all of the bigger players in the space are dealing with declining reserves and production. And the most tangible example of that is what happened in 2019 when Gary Goldberg and I put Goldcorp and Newmont together. And I remember Gary and I sitting around a table just like this and saying, well, on a pro forma basis, we're a 7.5 million ounce producer, but that's not sustainable. So let's make sure we cull the non-core assets within this portfolio and just focus on quality. And we have a core of 6 million ounces that we can sustain for 20 years, no problem at all. Well, 4 years later, Newmont has not been able to sustain that, and they've had to do Newcrest to get back up to that 6 million ounce number. So the industry is shrinking irreversibly, and given the lead time from exploration to first production at a new mine is 15 to 20 years, that decline is irreversible for the foreseeable future. And that's hugely constructive for the gold price as well.
Well, you would know you had an inside view of all that taking place. That's fascinating. Let's bring it back to Gold Royalty as we wrap it up. You're very blunt about the share performance. You said it's kind of been abysmal, but you say that investors are not paying for growth stories right now. Also, in your defense, you are still a fairly new player in the space. So the overall investment case for Gold Royalty, why should investors pay attention and say, hey, we're a Gold Royalty player and you should look at us?
Yeah, growth will come back into vogue at some point. And it'll happen when we start to see sustained momentum in the gold price. And then generalist investors will start to come into the space because they'll think they're missing something. And you'll start to see some of that capital filter down, not only to startups like ourselves, but I'm talking about the junior universe as well, which has had very inconsistent access to capital, which is why we've had such a lack of exploration success in the sector for a number of years. But again, it's becoming an existential imperative for capital to rotate into the growth stories, rotate into the exploration stories. And we're well positioned because we have a diversified royalty portfolio of over 200 royalties that are completely bought and paid for. Our growth of 60% CAGR over the next number of years is really a function of time. It's not a function of having to put capital. We have no capital calls on any of our royalties. That's another unique and attractive part of the royalty model is once you own the royalty, you own it in perpetuity, and we just have to wait and harvest our returns. And we're in a unique position in that regard, just to wait.
Well, thanks, David, and we'll be following. We'll be happy to see how the stock does and the company does.
Thanks, Mark.
Great stuff. Thanks, David. David Garofalo of Gold Royalty.